Tapping into your home's equity could be the key to buying your next investment property. But is a HELOC the right move for you? In this video, we'll break down exactly how a HELOC works, the smartest ways to use it, and the major pitfalls to avoid. If you're looking for a way to invest in real estate without tying up all your cash, stick around. This strategy might be just what you've been looking for. What is a HELOC? Unlike a lump sum loan, you can draw funds as needed during the draw period, generally 3 to 5 years. Once repaid, the funds become available again during this period, and you can use the funds over and over again. It's like your credit card secured by your home's equity. After the draw period, you enter the repayment phase, where you pay back the amount borrowed plus interest. And during the draw period, you generally have to pay interest only, so the payments can be very affordable. You don't have to use all the funds at once in a HELOC. You can withdraw only what you need when you need it. It's not just for emergencies, but HELOCs can be a powerful financial tool for strategic investments. When does a HELOC make sense for investors? Purchasing rental properties. Use equity to buy income-generating properties without needing a large amount of your own upfront capital. Funding renovations. Increase a property's value and rental potential by financing improvements. Bridging short-term financial gaps. Access funds quickly while waiting for other financing options like a refinance. The right and wrong way to use a HELOC. The right way to use a HELOC is investing in cash-flowing properties with a reliable income to cover the HELOC payment. Financing strategic home renovations that increase your equity can be a great reason to use a HELOC. The wrong way to use a HELOC is by using it for speculative investments with no clear return, or using it for non-investment spending that doesn't build your wealth or equity. Here's a pro tip for you. Always run the numbers to ensure the income generated covers the repayment obligation on your HELOC and leave some additional flexibility and wiggle room. HELOC risks and how to mitigate them. Since most HELOCs have variable rates, your monthly payment could increase, which is a big risk you'll want to consider. To mitigate this, you'll want to look for lenders that offer fixed-rate HELOCs or future fixed conversion options for an adjustable rate HELOC. A major risk with a HELOC can be over-leveraging or borrowing too much against your home's equity. However, you can mitigate this by setting a personal borrowing limit, and generally you want to avoid exceeding 80% loan-to-value on your HELOC. The steps to getting a HELOC. First of all, we need to look at the credit and income requirements. Lenders typically look for a credit score of at least 640 and a stable income in order to grant you a HELOC. Loan-to-value ratio. You can generally borrow up to 85% of your home's equity minus existing mortgages, depending on your credit score and property type. Shop for terms. I recommend working with a mortgage broker that specializes in HELOCs and can assist in comparing different lenders' interest rates, fees, and draw periods. The application process. Once you're ready, submit documentation to your lender and get the process going. They'll review your proof of income, do an automated or full appraisal on your home, and of course, review your credit history. A HELOC can be a very powerful tool for real estate investing, but only if it's used wisely. Now that you know the strategies and risks, the next step is making sure your finances are in top shape before applying. In my previous video, I covered the exact financial documents and steps you need to get pre-approved smoothly. Click here to watch it and start preparing today.